Market Efficiency Final Project, Abnormal Returns and Earnings Announcements by Samantha Kammer and Carly Christensen. For this project, we were asked to look at previous experiments that were either for or against the efficient market hypothesis. The efficient market hypothesis, or EMH, definition is as follows. In investment theory, that states it is impossible to beat the market because stock market efficiency causes existing share prices to always incorporate and reflect all relevant information. George Foster, Chris Olson, and Terry Shevlin conducted a research project in 1984. They were curious to see how the release of earnings announcements affected security returns. They gathered over 56,000 observations between 1974 and 1981. They found many interesting results from their research, including a 0.85 correlation between firm size and the magnitude of the earnings forecast. The magnitude between expected earnings and actual earnings was the main component for their research. What they found was only certain earnings expectation models came with specific results. There was proof that earnings announcements did have an effect on security returns, and to their surprise, these effects lasted for up to 2 months after the announcement was released. So, say a company's magnitude was positive. The company experienced positive growth in stock price, sometimes up to 2 months after the release of their earnings announcement. They also found that compared to larger firms, smaller firms were more susceptible to these effects. Although they had some strong evidence, it was not enough to prove weak market efficiency, and so the EMH still stood. When it came to our research, we decided to look at how the stock price varied after earnings announcements were released and what this might mean for the future growth of a company. To begin, we chose 5 well-known companies that are traded on the New York Stock Exchange: Apple, Google, 3M, ExxonMobil, and Procter & Gamble. We chose these companies because they are close in size and financial stability. One other factor, while they are similar in size and stability, it was important that they did not conduct the same type of business. These companies range from technology, oil and gas, consumer goods, and multi-industry companies. The first step was to go to the company's websites and look up the days their earnings announcements were released. Then, we gathered stock prices from Yahoo Finance for each company from 7 days before the earnings announcement, the day of the earnings announcement, and 7 days after the announcement. We looked at each quarterly announcement from 2013 to 2014. The company that hardly had any variations after an announcement was 3M. This would favor the EMH in that the stock prices were not affected by the earnings announcement, or it could just mean that 2013 and 2014 were stable years for 3M with not much change. In regards to Foster, Olson, and Shevlin's research, when companies had positive results, their stock prices consistently grew the next 7 days. The largest difference after an earnings announcement was $80. This could have been a major negative or positive reaction to the earnings announcement. The smallest difference was only $1, which in my opinion I thought could have been much smaller. Just with the research we did, we said that the EMH was false. Looking at how stock prices differentiated after earnings announcements was enough to prove that our experiment was true. If we had factored in many other circumstances and a longer time period, I would not doubt a change in our conclusion. We decided that if we were to do this experiment again, we would gather more data over a larger pool of companies that ranged in size and evaluate them separately, gather data over a larger time period, and run a regression on this data.